All right, so we promised, one thing I can't promise is keep this short. So I'm surprised there's anyone out here after 2 days of listening to speakers. So thank you though for the opportunity to be here. As Judge said, my name is Jarrod Compton. I act as director of our Native American Financial Services Group, or BOK Financial, and I did drag up here with the Vice President in our group, Will Revis. So you're only going to have to listen to me talk for a little bit. And then also part of our team is out here. We can direct any questions if they're too detailed to Sarah Alexander, who manages all of our underwriting and structuring for our Native American group for the bank, and Susie Williams, who works with Sarah. So with that being said, I wanted to talk briefly, trying to figure out exactly how the banking world can kind of dovetail with what you guys have been hearing the last couple of days. And I think what we'll try to do is just give you context to financing that we're seeing done in Indian country, specifically in the senior bank market. I think that over the years, Indian country has found different avenues and access to capital, whether that's bond or the senior bank market. What really has opened up in the last 10 years are banks' interests in financing with tribes. That's specifically what we do today, acting as a line of business for the bank. So briefly, a little bit about the bank, just to give you context to who BOK Financial is. If we're in Oklahoma, we see Bank of Oklahoma everywhere. It's on our arenas and probably about every other sign we can put in the Tulsa market. But BOK Financial is a top 20 regional bank in the country, about $40 billion in assets. What we're most proud of specifically is that pie chart, and that started about 13 years ago when the bank started to support some tribal relationships. Specifically, one of the first was Muskogee Creek Nation here in Oklahoma, and ultimately to this point in time has grown that practice into a national practice for BOK Financial, where we cover the entire United States with dedicated teams here in Tulsa, Albuquerque, New Mexico, and Phoenix, Arizona. So BOK Financial, again, 100-year-old bank. People know us as an energy bank, but most proud, specifically this team, of the fact that in our pie chart now is our commitment to our Native American practice, and the fact that we show up, and when the important people go talk to credit analysts and rating agencies in New York, they get to talk about what we do on a daily basis. Our team of about 20 people, again, spread across the market in those areas that I mentioned. This slide right here is really highlighting where we're at from a snapshot today in terms of our dedication to the space. We manage 38 tribal relationships in 10 different states today. Again, we call on a national basis. I will say that historically and even today, our practice really starts with the cash flow. And for 9 out of 10 of our tribal relationships, that correlates to gaming revenue. From that point, we look to expand our relationships much more broadly to the government side. But the United States, today there's 26 states that have tribal gaming. A lot of that is heat mapped, and I think just by luck, 3 of the primary states that do tribal gaming, Arizona, New Mexico, and Oklahoma, is where we put boots on the ground. And from that standpoint, we have dedicated bankers like Will and other bankers in those markets that call outside of those territories into larger concentrated areas. If you kind of go through that slide, one of the things that I'll just speak to is the size of kind of the commitment from a loan perspective. Today our loan portfolio is about $750 million in commitments in the aggregate to all of our tribal relationships. If you kind of break that down real simplistically, about 80% of those loans is what we refer to on the gaming side, and 20% on the non-gaming side. And what you'll see inside that from a financing standpoint is going to be infrastructure financing for tribal headquarters. But predominantly over the last 5 years, a lot of that financing has been made up of financing for healthcare clinics and hospitals. Over the last 3 years, we have raised in excess of $3 billion to the space. And so what that means, kind of at a high level relative to our hold position is per asset size, a 40 billion asset size bank, we have more dollars committed to Indian country than any financial institution in the country. Much like when you talk diversification and you try to define it by not putting all your eggs in one basket, that's bodes well into the banking world as well. So specifically, we have the privilege to act as lead arranger of a syndicated credit facility for the facility that we're in today. That bank group consists of in excess of about 8 different banks. So when we say we raise $3 billion in capital and we hold $750 million of those loans, we bring other banking institutions to partner with our tribal government, essentially to provide enough capacity for future growth. Not by surprise from anyone in this room, over the last many years, Indian country has accumulated significant wealth on the balance sheet, and we've had the privilege to utilize some of our services and products, specifically in our wealth management group. Today, actively manage about $1.5 billion in liquidity for our tribal partners. With that being said, I think what we want to do to provide a little bit of context is let Will talk about the typical structures that we are seeing in the space, that we manage, and then talk about a lot of the structural considerations that from a legal perspective might be of interest to you all. And since again, there's a lot of attorneys in the office, we'll highlight some of the loan documentation that we see that differentiates loans being done in Indian country that banks will require versus a traditional kind of corporate loan. Then we'll do Q&A, and hopefully there won't be a lot of questions. And then ran into Pat Cross earlier, and he said, be short and sweet and get everyone on the casino floor. So we're going to respect that. So I'm going to give the mic to Will and let him go from there.
I'm going to stay sitting if that's okay with everybody. It's a little more informal, which I like. So I'm going to kind of take a macro approach and kind of come down to the micro, and so start big picture and get into the nuts and bolts. And when I say that, I'm going to start with our philosophy and approach as a bank, and then move into the general structures that we use to basically provide financing to Indian country. And then we're going to get into some of the major terms, and as Jarrod mentioned, the necessary documentation that goes into that. So, when I talk about our approach, it's kind of based on 4 pillars, and that's the first and foremost, the team-based approach. As you see here today, we're never going to show up alone. We think that's important for our tribal customers to have a broad relationship management team so that, we can ensure customer service and responsiveness. And then that second bullet point, collaboration and partnerships, another important one. We never try to come and dictate terms to our partners. We want to hear what their hot-button issues are, and then try to structure transactions accordingly. Because what goes hand in hand with that is trying to act in the best interest of tribal partners and ultimately tribal citizens. We know that ultimately whatever we're doing is ultimately going to be impacting the citizens of whatever tribal entity that we're working with. And then lastly, what I want to highlight is the experience and knowledge of this team. Across those 20 people that Jarrod mentioned make up our Native American practice, collectively we have over 100 years of combined experience in banking and 50 years in Indian country specifically. So those are kind of our guiding principles. And now we'll get into some of those tools that we use to put transactions together in this space. And generally, there's 3 high-level structures. There's non-recourse structures, recourse structures, and then cash and investment secured facilities. And when we're trying to pick between the 3 of those, what we try to determine is the need and the impact. And whenever I say the need, it's what's the primary driver. So is this a gaming project, is this a government project, etc. And then whenever I talk about impact, what impact is that structure going to have on the credit profile of the nation or entity? How will this impact distributions, say if it's a gaming operation, and ultimately impact tribal citizens? And then lastly, how is this structure going to impact the future needs of the tribe or tribal entity? And so when you think through those things, generally those non-recourse structures are typically loans to gaming operations. They're not a general obligation of the tribe. What we do is we carve out the cash flows and related assets of the gaming operation, and that's what provides repayment and also collateral for the transaction. You know, it's important to note on these that loan payments are always made prior to tribal distributions in the waterfall, and so these structures could have an impact of distributions. So what we always try to do a lot of work around is what is the tribal distribution need and what kind of cushion do they have today with the financing in place and the pro forma debt service. You know, second, our recourse transactions are general obligations of the tribe, and generally these loans are made to the tribe directly, and generally for government projects like healthcare clinics or government buildings, etc. These loan payments are made by the tribe, and so whenever you're considering distributions, you can get creative to make sure that there are no impacts. And so it's kind of a neat structure. And then lastly, it's cash or investment secured, and these are always going to be the cheapest and most flexible form of financings for our partners. You know, generally they're securitized by cash and investments at certain advance rates and are very, very cheap. And so, you know, as mentioned, again, to stress this point, you know, those three big structural considerations are, you know, how is this going to impact the credit profile, which will impact the capacity for future projects and debt financings and ultimately, you know, distributions. Because, you know, distributions are really, at this point in time, especially with most of our tribal clients and their gaming operations, the main driver for, you know, the government's budget and kind of economic success. And so, you know, there's, going back, you know, between a gaming operation and general government loan, there are some differences. For a gaming operation loan, what we're generally looking at is the cash flow and trying to understand the cash flow, because in reality, these properties are on land in trust and you can't protect on land, so really, you're making a loan based on the cash flow of the operation. So it's important for us to really try to understand the competitive dynamic, whether that's new properties coming online, renovations or expansions, or changes in the regulatory environment, such as you know, compact negotiations or potential changes to state compacts. And then on the government side, what we're generally looking at is the balance sheet. And a lot of times how we structure those is generally looking at the cash position of the nation and determining whether or not in a severe downside they have enough liquidity on hand to repay their obligations. So it's two drastically different ways of looking at things if you think about it. And so, you know, generally some of these credit facility structural points are the same between those two facility types. Term is always generally up to 5 years, just like it would be for any corporate loan in the senior bank market. Security is drastically different. Generally on recourse transactions, given that they're general obligations of the tribe, you know, those are generally unsecured with certain minimum liquidity covenants that we'll kind of cover more in the financial covenants below. And then on the gaming operations, it's secured really by the cash flow, and that's it. And the repayment period is drastically different between the two based on those security positions. When you're dealing with cash flow, you're going to always have a quicker repayment, generally up to about 10 years. And then on the government side, given the minimum liquidity requirement, those are going to be repayment periods of anywhere between, you know, 10 to upwards of 20 years sometimes.
I think I'd kind of quickly highlight and kind of pause there for a second, because I think it speaks to the testament of just the financial world getting more and more comfortable with partnering with Indian country over the years. So if you kind of rewind the clock a little bit from a repayment standpoint, even going back, you don't have to go back far, but call it 5 years back. And so as Will commented, when you think about most of the transactions for larger financing being done in the space, where it's not a geo of the nation, which is essentially a balance sheet look, and it's accretive to CapEx for the cash flow entity, which 9 out of 10 times is related to gaming. The repayment period used to be quick, and so as he identified from a collateral standpoint, these are truly cash flow loans, given the fact that the property's on trust land, you can't take a security interest in the property. So you think about a corporate real estate transaction, they're going to tie it to the useful life of the asset. So much like your mortgage or your home, you're thinking 20, 25, 30 years. In this scenario, the market even 5 years back, the repayment is much quicker, 5-year kind of repayment terms, which is significant requirement when you're talking about hundreds of millions of dollars for such properties. What's happened is more and more banks have gotten comfortable with the uniqueness of the space, which has had changed the competitive dynamic and landscape, which ultimately, for our partners in Indian country, has given them the benefit to stretch that repayment terms. And that's really moved to the 7 to kind of 10-year repayment, where the banking market, and we think specifically BOK Financials, continue to differentiate itself and kind of be in the forefront from a leadership perspective in the space, is to be creative with the structure. So we might have a term component, but add a revolving line of credit that's also used as a piece of the capital instrument to provide financing for a project that doesn't have a repayment. You're only paying interest only on the funded. So you end up with an effective amortization, to Will's point, that gets beyond that 10 plus years, thus giving flexibility ultimately for the tribe to still receive adequate and hopefully year-over-year increased distributions from the entities in which they're plowing their resources back into.
Yeah, I think that's really important to highlight. Another thing that kind of dovetails with that in the repayment period is a lot of times we often think like our mortgage is longer is better. But it's often the case, there's so many projects in the pipeline with tribes that it's important for them to be repaying debt so that their credit profile remains strong to very strong and doesn't deteriorate because they're taking on new debt while having legacy debt kind of remain outstanding because those repayment terms get overextended, I would say. So just kind of moving along that list after making that point, I would say prepayment generally across all structures in the senior bank, it's all flexible. As long as it's a floating rate instrument, you can prepay with no penalty at any point in time. Pricing is an interesting one because it varies. With a cash secured facility, it can be very cheap, maybe below LIBOR plus 1%, and then that can be anywhere based on the credit profile of the tribal entity borrowing. Is there anything you add really?
No, I think that kind of, Will's kind of comment around always constantly deleveraging, specifically for the standpoint of maintaining adequate credit quality, where essentially you always have the upper hand. We like to think that our partners enjoy the banking relationship, but I know if I put my shoes on the other feet, I would always want to feel like I was positioned well. And one way to position yourself well is to always have a strong balance sheet, never be too over levered, and show strong historical cash flow. If you have those things, you have the upper hand on a bank to make sure that you're always negotiating the best deal on your tribe's behalf. And as attorneys that might support these transactions, ultimately that's where you want your partner to be as well. The pricing component dictates that credit profile. So a lot of it in Indian country is built off, we keep referencing leverage profile, but it's basically your total debt, what we refer to as funded debt, divided by your EBITDA, which is essentially your cash flow. We like to see that kind of in the 1 to 2-ish terms from a ratio perspective. As it gets higher, pricing gets higher. As it gets lower, pricing gets lower. Just kind of hit a couple of these as well. Financial covenants, they've become relatively standard. We always look at some type of cash flow coverage relative to servicing the monthly, quarterly, annual debt service requirements in terms of the repayment, principal, interest on the loan. That would also kind of encompass what we're seeing go out from a cash outflow standpoint. So maintenance, CapEx, that's not financed, and ultimately distributions back to the tribe. The other one, which we've commented on, is the leverage profile. Limitations on additional indebtedness. is always a highly negotiated item. I'll tell you, it's either zero or it's a bucket that's negotiated. And the purpose of that ultimately is when financing is being provided to any entity or any institution, the decision is made at a point in time based on the financial statements that have been achieved at that moment. Again, going back to the tenor, the profile of these transactions, 9 out of 10 transactions have a maturity life of 5 years. So ultimately, you're trying to protect yourself over that period of time that your borrowing entity is not going to have additional debt service in the future after you've negotiated and executed a contract with them. I'll let Will talk a little bit about really the biggest hurdle and then what has allowed more banks to get into the space and become a supporting partner with Indian country is the willingness and tribes' understanding of what a limited waiver of sovereign immunity can provide for them from a financing standpoint.
Yeah, I think this is generally one of the more heavily negotiated language items in a loan agreement. It's just the limited waiver of sovereign immunity to ensure that, you know, we have an enforceable document under legal terms that our attorneys understand, quite frankly. And then what goes hand in hand with that is like the jurisdiction arbitration language. Generally, what's become custom in the senior bank finance market is you have a waterfall that puts you in federal court first, state court second, and tribal court third. And then to kind of come back to those financial covenants a little bit in the leverage profile that Jarrod mentioned 1 to 2 times. If you're dealing with, you know, large corporates, you'll understand that's generally pretty low for a corporation to operate, but that's generally due to the lack of real estate collateral again in this space due to the land and trust, etc. You know, with that, we'll kind of segue key documentation and get you guys out to the gaming floor here as quickly as possible. You know, the documents generally are standard for, as they would be for any corporate transaction. We have a credit agreement that basically is the Bible for that particular transaction, which often has a security agreement either embedded within it or separated out. What goes hand in hand with that security agreement are depository account control agreements, or DACAs. As we mentioned on gaming transactions, the cash flow of the enterprise is really the only collateral that banks have, and so as a result, we try to have as much control as we possibly can over that. And when I say control, I mean is a security interest in that cash flow and the accounts that cash flow is deposited into. And so if that bank or if that cash or money is not held with Bank of Oklahoma, generally we try to do when we lead or are the financing partner on a transaction is have control agreements in place with the primary depositors of the gaming enterprise. Promissory notes are standard across all transactions, and what with authorizing resolution, you get something that is unique to, you know, tribal transactions. And this is again to make certain that we have an enforceable document. You know, we spend a lot of time trying to understand each individual's tribe's constitutions and setup and who has authority to enter into what transaction and what resolutions need to be passed in order to gain that authority. What I'll highlight next is actually a item that's often overlooked, which is non-interference agreement. Sometimes this is embedded in the credit agreement, and oftentimes it's its own separate agreement. And you know, this basically lays out a framework which the tribal government can't interfere with the gaming operation to the detriment of the lender. So this is imposing any new taxes or priority distributions, etc., on that gaming enterprise that could severely impair the bank's position. This is often overlooked with certain tribes that require a general assembly, so all tribal citizens over the age of 18 consent to enter into or enter into a limited waiver, because there is limited waiver language in this non-interference agreement. So what I would say is if you're working with a client on the front end, this is something that everyone should try to keep in mind. And lastly, it's on gaming transactions, we require an NIGC deck letter. The reason for that is that there was a court case for a tribe up in Wisconsin who basically argued that their loan agreement constituted a management contract, and as a result, various federal courts opined, and that loan agreement was declared null and void because the NIGC hadn't put an opinion on it. There have been some court cases since then that took the opposite stance, but generally, banks being cautious, we always get a declination letter from the NIGC. And with that, unless Jarrod has anything to add on any of those points, we'll turn it over to Q&A.
That's it, it's 3:40, so we're 20 minutes early. So with that, we will take any questions.
I have a question, actually, Will. Will, I'm from Compton County. I know you've got some connections there, so this question for you. I get frequent calls from non-Indian vendors and contractors that are not working on large projects, they're working on relatively small projects. And of course, their concern is not being from Indian country, they have concerns about, they're not familiar with the tribal court system. They don't understand, or they understand incorrectly sovereign immunity. Most of them get whenever I tell them, no, don't ask for a waiver, we're not going to do that. But my question for you is, what is the bank doing to evolve to facilitate relationships and contracts between those companies that are outside Indian country to doing business inside Indian country and making them feel comfortable about the process?
Go ahead, and I'll follow up.
Yeah, that's interesting. Generally,
There's a lot there.
yeah, there is quite a bit. And, generally we always, broadly speaking, try to act as an advocate for Indian country, because I do think that the people lump all tribal nations into this idea that everyone is Indian country in the sense that each tribe is exactly the same. And that's frankly not the case, just like each individual sovereign nation is differently. So what I'll say is there's varying levels of comfort depending on ultimately, the political and tribal stability. So that's something that we try to educate our partners on quite a bit, which is just treating each individual tribe individually. And then secondly, it's a really tough question, to be honest. Jay, what are your thoughts around?
No, I think Will's kind of just foundationally kind of how he answered it is the foundational kind of answer to the question. And it kind of all will stem with continued kind of education in the space, education on the continued evolution of sophistication within the tribe, specifically on the legal and the government side, which is becoming, there's more and more financial institutions that do a lot more outside of partnering with Indian country, the bank corporations that you speak of that are wanting to do business with Indian country minus the waiver, that will continue to be an advocate. I mean, that is going to take time, I think, and it's going to take continued kind of awareness of the sophistication, the talent that's inside the structure, a timeline that continues to elapse where there hasn't been issues, and that, Will's comment on where the banking market is relative to the requirement to deal with the NIGC on getting debt letters for any gaming transactions. That was because of an unfortunate situation that now is years past. That practice still hasn't changed for banks, although we've seen cases where we've got a different viewpoint. I think that evolution will continue to happen on our side. So I think it's continued just awareness and patience, and that's not the greatest answer. But I think as an institution that supports Indian country, I mean, you've got advocates out there that are speaking. I think separating yourself if you feel that you're an outlier and not getting bundled into kind of someone's packaged theory of what they think about your tribe specifically. It's probably a step that individually you can take because Indian country doesn't all look the same. We don't think every one of our tribal relationships is the same. Every tribe is their own sovereign nation under their own constitution, and I think differentiating yourself as a tribe from a sophistication standpoint and just educating that potential partner, you get to own a little bit of that, and I think time is going to allow for that to happen.
That was a much more eloquent answer.
There's a lot of stuff and not really answering it. It's really the honest answer.
So I think this is a related question to that. Is under the dispute resolution clauses that you enter into, what would give banks and investors confidence that that any dispute that would come up in the agreement would be first handled in tribal court, as opposed to an arbitration or federal or state court? It would be the tribe having like a UCC code or something like that?
Yeah, I think that, there are some very, very unique circumstances where certain banks I can think of one transaction in the last 10 years where someone agreed to tribal courts. I think what ultimately is going to drive that is continued relationships, familiarity, and precedent. I think a lot of it's that same answer. It's basically continuing to work with tribes, understanding the level of sophistication of individual tribal governments, and ultimately there has to be a point where banks feel comfortable taking marginal risk, getting used to it. We don't do anything 2 feet first into the water. We put our toe in, our foot in, our leg, and take this very incremental approach. And so if that ever happens, it would probably be very, very incremental and slow. I think would be my general comments.
Yeah, and I think it's like that question was posed even 5 years ago, as we just referenced kind of before. And it's very interesting to just see the structural elements change in the space, and all that's driven by the competitive landscape, more and more financial institutions understanding how to support Indian country and choosing to partner with Indian country has driven more favorable structure, has driven more favorable pricing. And so 5 years ago, someone could ask that question and the answer would probably be never. And I think what Will's saying is the continued competitive pressure, which is a testament to all the success that any country is having. Someone will fall first and get comfortable, and it'll probably be with a lot of exposure and a long-term relationship with a tribe or a nation that they've been banking for a long time, that is holding all the cards and says, we want to continue to partner with you, do business with you, but this is very important for us based on a litany of things, and this is how you're going to continue to partner with them. And that will happen at some point, I can imagine. And I think 5 years ago it was never going to happen. I don't know if that's 5 years from now or 10 years from now, but I think it's the continued education, continued evolution from a sophistication standpoint, and then just like anything, one person's got to do it first, and then everything's market driven.
And what I would add to that, if you look at the emerging market debt universe, so say Argentina bonds, generally when you look into those instruments, even if those are U.S. investors in a U.S. bank, those are generally governed by U.S. laws with a lot of arbitration language and jurisdictional laid out in those agreements. So this is something also, when I think about it globally, it's not necessarily unique to Indian country, it's just unique to sovereign nations dealing with one another.
Thank you all.